Well, thank you for joining me for this video. What we're going to be doing here is, as you can see, I have a balance sheet in front of me. This is Walmart's most recent balance sheet. Notice it's for 2015, 2014, and 2013. And what we're going to be doing is really kind of going line by line and walking through each of the different entries that you'll find on this balance sheet here. Notice this is displaying simply just assets. And then in subsequent videos, we'll go through liabilities and owner's equity. The idea is to give you kind of a working knowledge of some of the different components of a balance sheet so that you can, one, be able to read them, but also interpret the information on your own. We'll work on financial analysis in the future, but the idea is that if you look at a balance sheet, you should be able to get a general idea or a general gauge as to the health of the company and potentially be able to point out maybe some of the issues related to a firm's financial position. Now, before I get too far into the video, if you haven't already, what I would encourage you to do is to take a look at some of my prior videos in which we go over the structure of the balance sheet, income statement, and statement of cash flows. So you can search for those, you can find them relatively easily, and definitely go through those. That's generally helpful for this because that kind of gives you some idea as to the purpose of the statements and a general structure, and then we talk about some other elements as well. So kind of lays a little bit of the foundation for the concepts we're going to talk about here today, where we dive a little bit deeper into each of the three financial statements, the balance sheet being this video, of course. So let's start by kind of going into how the balance sheet is sort of organized. Notice that this balance sheet, at the very top here, there are three different dates. So there's January 31st of 15, January 31st of 14, and January 31st of 2013. This is what we call a comparative statement. So what is done here is it provides us with the same information over a period of time. So as an investor, what you would have the opportunity to do is then make comparisons from our current balance sheet to a year ago and make, kind of draw some conclusions as to, what the changes are. And you can look into the annual reports to see, well, what are those changes? Is it a positive trend? Is it a negative trend? So it really helps with the analysis piece. So that's what those three dates represent. Now, notice here where it says all numbers in thousands at the very top. This is an important thing to key in on. For example, looking at the very bottom, Walmart's total assets, it says $203 million. So that actually represents $203 billion in assets, or a little bit north of that figure. So usually on financial statements, you're going to see all numbers in thousands. This just means that they cut off 3 zeros, so 3 decimal places, because really, it would take up far too much space to convey the financial information. So just make sure when you're doing your analysis that you're representing the data accurately, because, it could be, 9 million is a lot different than 9 billion, of course. So just a little kind of FYI there. So let's kind of look through the general structure. So we're looking at assets here, and we know that assets are things that the company owns that provide value to the firm in some way, shape, or form, whether that's the ability to acquire additional resources, like, if we have cash and we can purchase things, or if it's equipment that allows us to provide provide a service, or maybe it's something intangible like a patent or trademark. So let's kind of go through this. The first thing you'll notice is there's a distinction here. We have what are called our current assets right up here. And these represent those assets that are likely to be turned into cash in less than a year. And this is an important thing to, when you're looking at a firm's financial statements, particularly the balance sheet, this is a really important element here because, if a company is struggling financially, one of the things you really want to know is, well, if we had to sell some things, what do we have available? What can we convert into cash relatively quickly to pay off, whether it be creditors or to meet payroll obligations? So this is a really important metric, important thing to think about is the kind of relative percentage of current assets to total assets, and is that, a relatively strong number. So looking through current assets, you'll notice that everything that's listed under here is designed to be turned into cash in less than a year. Doesn't mean that we absolutely need to. It just means that if we wanted to, we probably would have a reasonable chance of doing so. Now, we list these items under current assets in the order of what we call liquidity. And we talked about liquidity in a prior video, but liquidity essentially is how easily or how quickly can something be turned into cash. So kind of going line by line, notice the first item is what we call cash and cash equivalents. So cash is the most liquid asset because it already is cash. It exists in that form. Now we have approximately just north of $9 billion in cash and cash equivalents. So that isn't all held in cash though, because you're probably curious as to, well, what does this, cash equivalents figure represent? Cash equivalents could be a variety of different things, but they generally are very, very liquid. Usually cash equivalents are things that are converted into cash in 3 months or less. So although it isn't cash necessarily, it's relatively liquid and we can get access to it relatively quickly. So let me give you a couple of examples of what could be cash or cash equivalent so you kind of know. This might be different for different firms. So we're looking at Walmart here. If you're looking at a different company, what I would encourage you to do is to look at their annual report and you might gain some insights as to what could cash equivalents include. It might not be these things, but there likely is some overlap. So cash equivalents can include a few different things. It could include investments that the company has, whether that would be in other companies or really anything else for that matter, that is going to mature in 3 months or less. So if we have a particular investment, let's say it's a bond that we have, whether it's in another company or a government bond, and that bond is scheduled to mature in 2 months, we would classify that as a cash equivalent because although it's held in a long-term investment, that investment is maturing, which means we're going to have access to cash in a relatively quick time frame. If a company holds money in like a money market mutual account where it's, very, very liquid, that would classify as a cash equivalent because they can get access to it relatively quickly. What's interesting for retailers that's different from other firms is cash equivalents also includes credit and debit card transactions because when you go to a retailer like Walmart, for example, and you pay with your credit card, sometimes that payment doesn't funnel to the retailer right away. And so Walmart specifically, what they do is if they can reasonably expect payment within 7 days, they classify it as a cash equivalent. If they cannot expect payment within a reasonable time frame, so within 7 days, then they would classify it as a receivable or an accounts receivable. So that's a couple of things that would be included there. So investments that are maturing within 3 months, and they can also include credit and debit card transactions where the bank is holding the funds and they're going to be though paid within less than 7 days, or there's a reasonable assumption that they would be paid in less than 7 days. Now, when looking at this figure here, this $9.1 billion in cash, that sounds really, really good, right? If you've got $9.1 billion just sitting around, we can pay for a lot of things. One of the things that you might want to think about is, one, that all isn't in cash, right? So we know that some of it is cash equivalent, so we're not going to get it for, at least 3 months or so, or maybe even shorter, depending upon if it's a financial transaction. But the other thing to think about is a lot of times firms don't hold all of that money in one place. So some of this money might be might be domestically, so it might be in the United States, and I believe that there is a relatively good portion of it that is included in the United States. But there's also another component of it that's included overseas because it was generated via sales or revenue that was collected in overseas markets since Walmart is an international company. And those funds aren't readily available in the U.S. So out of this $9.1 billion figure, 6.3 billion of it, so, you're talking roughly 2/3 is held in international markets. And so it's held overseas somewhere. And so that begins to kind of shape your kind of opinion as to, well, how much money do they have in one place? So again, it's not all in the same location. It's dispersed between a variety of different locations. A lot of that is taxes, some from the foreign countries that prohibit money being moved around, and some, if you move it back into the U.S., sometimes it gets taxed. So a lot of firms will hold cash in international markets for that very reason. Now, moving on down the list, we have net receivables. And net receivables are essentially accounts receivable, but they're money that is that we are anticipating receiving in a period of time. And so we've essentially are accounting for this as money that is going to come in the future, but it's generally not going to come in within, a few days or so. We're talking a month or maybe more than that, but certainly less than a year. So, again, this is really important because a lot of times when we're talking about assets, converting into cash, receivables, we might not be able to convert all of them into cash for a variety of reasons. So one of the things that you're probably curious about is what would be an example of a receivable for like a company like Walmart. There's a few things that this could include here. For Walmart specifically, because they have a pharmacy, they handle pharmaceutical sales. And so a lot of that involves billing insurance companies. And when you're billing an insurance company, if you've handled anything in the medical field, you know that doesn't necessarily always go very, very quickly. So part of their $6.7 billion in receivables is money that is being owed by insurance carriers. When customers come in and pick up a prescription, Walmart will, of course, bill the insurance. That's money that should be coming in, but of course, we haven't received it yet. This will also include banking transactions for customers that pay with credit cards and debit cards that will take in excess of 7 days to process. And so if there's a very unique transaction and it takes more than 7 days, or it's believed to take more than 7 days, then it will count as a net receivable as opposed to this cash and cash equivalence feature that we just talked about before. We'll also include real estate transactions when we're anticipating getting some type of money from that particular transaction. And it can even include suppliers. So when we do business with suppliers and they haven't yet paid, then some of that's going to be included in the $6.7 billion figure. Walmart specifically, if they're given incentives for promoting certain products, right? So if they're given shelf space or something like that, and that's like pre-negotiated, and they haven't been paid yet from the supplier to actually, provide the marketing incentive, then of course that's money that we would expect. Those are net receivables. So moving on to inventory. So inventory, we know, is items that the company owns that, are primarily for the purpose of selling. So Walmart, of course, you'll notice out of this, $63 billion in current assets, inventory is a really large component of that. And the reason for that is it's really imperative to their business model. If Walmart didn't have a lot of inventory, that's a lot of lost opportunity. So, when you're looking at a retail organization, you're going to see a disproportionate share of their current assets being held in inventory because they need that inventory to, of course, sell and generate revenue and then cover their operating expenses. So that's one of the things that you'll think about here. Inventory, of course, is something to definitely monitor, particularly when it gets too high. You start looking at, what's the age of the inventory? Are these items that we're going to be able to sell? That's a really important thing because, again, we're assuming that, $45 billion we have in inventory, we should be able to sell through a lot of that. But if we're holding old inventory, so inventory that's whether it's products that are obsolete or there's new models that have come out, we're going to have to take discounts on the particular inventory to move it out of the store. Again, that's going to impact, the money that we generate from those particular products. So again, retailers will have a disproportionate share of their current assets held in inventory because that's how they generate revenue. Now, the next thing we're going to look at is this other receivables piece or other current assets piece. This could be a variety of different things. And what you'll want to do is you'll certainly want to look through the notes for the annual report and the financial statements that are published by the company to get a sense of, what are some of these other current assets that the company might be holding. Typically, they're low-valued items. You might look at the figure and say, $2 billion sounds like quite a bit, but it's usually a lot of smaller things that added up equal the $2 billion figure. So it could be, a number of different things that aren't included in cash, cash equivalents, net receivables, and then of course our inventory as well. So those are the current asset figure. Now let's go to our other assets or long-term assets, which by definition are, kind of not necessarily involved with the selling of items necessarily, but they're generally to support the operations of the company. And so these are items that, we really don't have the opportunity to convert them into cash in less than a year. And usually we wouldn't want to unless we were in some kind of dire financial circumstances, which you can argue that probably wouldn't be Walmart's situation. So the first thing we're going to look at here is going to be the plant, property, and equipment, since that's the figure that we have a number. And we have $116 billion in plant, property, and equipment. Now, that includes a couple of different things, so I'm going to go ahead and note what that could include. That could include land. So if we have actual land itself that Walmart would own in this case, that has some type of value that's assessed, and then we can report that as the value on the balance sheet. Typically, we will report it as the purchase price of it, so what was paid for it. The other things that might include could include buildings. So Walmart has physical stores, so the buildings that go on said land, those are of course valued, so that's constituted or held in the $116 billion figure. Will also include fixtures and equipment. So fixtures being kind of the displays and the different wire racks and things that Walmart has to hold products for sale, and equipment being items that are used in the operation of the business. So this could include, equipment to move pallets back and forth. I'm not quite sure what the exact name of them is, but those types of equipment that are used in the operations by employees to conduct business. The next thing, or last thing I should say, that this property is going to include is it's going to include transportation equipment. So transportation equipment is mainly going to include the trucks that Walmart owns to kind of ferry products back and forth between distribution centers and then to the stores to get them on the shelves relatively quickly. So that figure is $116 billion. It's pretty sizable. Obviously, Walmart is a very capital-intensive business because it's moving products. It's really kind of a logistics company if you think about it, and everything at time is very important for them. So they spend a lot of money on the logistics, on the footprint of their stores, because they do have rather large stores. That's part of the value that Walmart provides, all of these different products in one place, and you're kind of seeing that reflected on the balance sheet. And the next element I want to talk about briefly is goodwill. Now, goodwill is an accounting transaction or accounting figure that is noted to report kind of the value in excess of what we call the book value of transactions or for items here. So what happens is if Walmart purchases a particular item for a certain price, goodwill would be the fair value of that item in excess of what it's purchased for. So that's generally what it is. And so if we purchase, let's say property or land, for example, and we pay $100,000 for, I'll write this here, so $100K for said land, and we have it assessed and it's worth $125K, well, then we would report $25,000 in goodwill because it's a fair value in excess of what we paid for it. What you might also see book value represent is during times when a firm is potentially going to be acquired, goodwill rather will represent the what the company is valued in excess of its assets. And so if its collection of assets, let's say, is $10 billion, and the company is going to be sold for, let's say, $15 billion, you would say that $5 billion is goodwill. It's kind of the brand of the company and the what consumers think about it and those sorts of things that you can't necessarily quantify, or we try, but it's difficult to quantify on the actual balance sheet itself. So that's what we call goodwill. Now, moving on to kind of this last element, you'll see other assets. And other assets, again, is going to be a variety of different things. And what I would encourage you to do is look through the annual report and particular manager's notes and things like that to kind of go into, well, what is this figure here? If you're analyzing a company, you really want to try to get a sense of, what are, these assets here, like other current assets. What does that represent? What does other assets represent? Because it's really important if you're trying to do a thorough analysis, you really want to get a sense for what are all the intricacies in the company so that you can make an informed decision as to whether or not they're in a strong financial position.